want to go straight to Robert Herjavec, who's the Shark Tank investor, who's warning that basically stocks haven't fallen as far or hit bottom yet. Before we talk about that particular point, what do you think on this bigger issue? Do you think that the Fed, their credibility being on the line, will continue to jack up rates to the point where, yeah, the economy may go into recession, but they will get inflation down to 2% again?
Well, I think, Richard, that the Fed moved very quickly to try to stop inflation, and it was a bit of a shock to the system. So, I mean, it's anybody's guess, but I think the rates are definitely going to go up, but I'm hoping not at the same rate that they've been going. I'm hoping that the Fed will kind of cool things down a little bit, but I still expect them to go up and see increases.
It is the fear of these rate increases and the reality now that has pulled so much value out of the market. I see one number, 5 trillion or something in value out of the market, but you don't think it's over yet?
I don't. I think what's really happened is that it's been a bit of a wake-up call, and what it's done is it's made people go back and look at the valuations. And what we're seeing, I mean, we're in the tech space, the cybersecurity space, but we do a lot of investment on a private capital basis. And I will tell you what the Feds did was it was a wake-up call for any company that doesn't have a reasonable path to profit. Investors are standing back. It doesn't mean that they have to have positive EBITDA today, but to have a reasonable path to profit. And I think what you're seeing is a lot of that stuff is being shaken out of the system right now. There's still a lot of great companies making good money, right. But if we're honest with ourselves, there was a lot of companies that had ambitious plans towards profitability, and I think a lot of those companies are going to continue to get hit.
You know, as you said, basically the path to profitability, I was taken back 20 years to the dot-com boom and bust, where that, you know, companies were told they had to be on a path to profitability. And I mean, it's slightly a philosophical question. Have we learned nothing since?
Right. Well, it's funny. Somebody just asked me that the other day. I do think it's slightly different. I don't think this is the dot-com bubble where a sock puppet gets a $4 billion valuation by simply having an internet address. So I don't think it's that. These are good companies, but the valuations were crazy. I mean, they went way up. So when I say I see a continued decline, I'm talking on a percentage basis from where we are today. I do think, though, that the bigger issue for a lot of these companies is employment. It is very, very difficult to get people to come. I know even on a retail basis, some of my friends who own restaurants, Richard, they have to shut down a couple of days because they just can't get workers. It's hard to make your revenue number when employees won't show up in an industry where you need them.
So now it begs the question for all those people, myself included, who are showing very serious losses in some aspects of the portfolio. And for those people who are thinking of retiring, it doesn't matter which jurisdiction we're talking about, whether it's a 401k in the US or an ISA in the UK or some other tax advantage savings, pension savings in Europe. The reality is people have less wealth to start planning their future than they did before. And it's too late for them to do anything about it.
Well, so I'm of two minds on that. I'm a very conservative investor with my personal money. I mean, I'm a risky cyber tech guy. But here's the good news. The yields for people in retirement and people that are thinking about retirement are going up. The reality is you kind of have to temper your expectations. Are you going to make another 20% in your portfolio like you might have last year or the year before? Probably not. Are you going to lose everything? Probably not. I think that there are really good companies that are having a market correction. That's what I would call what we're going through, is a market correction. It's not like the dot-com where these companies are going away en masse. But the good news is yields in very conservative things like bonds, interest rates, are finally going up to a little bit more of a livable standard. Mind you, it's only 2, 3, 4% that you're going to get on interest rate or a yield, but still there's some optionality there.
What I
But
love to
don't
talk.
retire.
No, well, thank you, thank you. If I was planning on, I'm not now. Look, you're optimistic. I mean, I like the tone of what I'm hearing from you because there's so much gloom, and you're not being halcyon. You're not being sort of Pollyanna about it. You're being realistic, but you're telling me there's optimism.
Very well said. I will tell you, as I canvass all my friends who are successful or not successful but own businesses, there is a general feeling of optimism. Businesses have real issues around employment, but interest rates for a lot of the industries aren't really driving the core values of the business. It's affecting some consumers. It's going to have an effect on some housing, but only in certain markets. Look, how long has it been since people could even buy a home? If it cools down a little bit, I think on a macro level, that's going to be goodness for some people. But yes, I'm very optimistic. I think that the level of innovation and supply, and look at the unemployment rates. Like there's a reason people are employed is because businesses are doing well. And I think all this supply chain is eventually going to work itself out. We just have to be a little bit patient.
Not something many investors like myself are terribly concerned, are very much using. Good to see you, Robert. Thank you, sir. I appreciate your time tonight.
Good to see you. Thank you.
Good.